Alright, we're going to continue with our Chapter 3 lecture. This topic is going to be on deferrals, which is also known as prepaids. There are two different types of deferrals that we can look at. The first is prepaid expenses, and the second one we're going to look at is unearned revenues. So for prepaid expenses, some of our common prepayments would be insurance, supplies, rent, also fixed assets, buildings, and equipment are some of the other things that we could look at in this deferrals or prepayments as far as expenses go. When we look at adjusting entries for a prepaid expense, what we are going to do is we will debit an expense account and we will credit an asset account whenever we look at these prepaid expenses. As you see, with all of our adjusting entries, you should have one income statement account and one balance sheet account, which we do in this example because we have one that's an expense and one that is an asset. The first one I want to look at is the supplies accounts. So when we purchase supplies, we look at our original entry, and so that's what we're looking at here. This is what entry we actually will put into the books when we purchase our supplies. Now, over the course of the period, we're going to use these supplies, and so on our adjusted trial balance, we would actually show the amount of supplies that we purchased, which is $1,500 as an asset. We also have to realize that we have used these supplies over the period of time. Now, there are two ways that we can look at this. One way that we can look at it is we can actually take an inventory of what our supplies are, and we can look, and it could tell us that your supplies should have a balance on hand of, we'll say $500 on hand. So what that means is that the balance in your account should be the $500. So we have to figure out what our journal entry is going to be. So we would look at, and we can look at a T account here, and what it's saying is that $500 is what our balance should be. In the trial balance, it's showing $1,500. So we have to look at how do we get from $1,500 to $500. And we would need a journal entry. So we would need a credit here to get to that balance, and the amount that we would have there would be $1,000. So our journal entry here, remember we need one, our debit has to be the expense account, so we would have our supplies expense account, and that would be our debit account, and our credit account would be the supplies account, because we are reducing that account. And so when we get finished with this particular journal entry, our balance would actually show that $500 amount. Now, the other way we could look at it, we could have the $1,500 in our account, but it could tell us that we have used $1,000 worth of supplies. Now, if it gives us this and it tells us that this is what we've used, then this is actually going to be the journal entry amount. So what we would do there is we would just write the journal entry amount for that amount, and so we would have supplies expense for $1,000 debit, and then supplies would actually be our credit account that we would have in this particular case. So those are the two ways that we could look at the supply account. Another thing we could have is this prepaid insurance. Prepaid rent works the exact same way as prepaid insurance does. You can find the amount on the trial balance. So let's say that we already had insurance. We had $6,000 in the insurance account. If the $6,000 was for a 1-year policy and 2 months of it has expired, we would have to go in and figure out what the amount we would be using is. So what we would do is we would take the $6,000. If it's a 1-year policy, that means it's 12 months, so we would divide it by the 12 months, and that's going to find our monthly amount. And what we find is we have $500 a month. Then you were going to take the number of months. So if it's 2 months have gone by and have expired, then we would take the 500 times 2, and that would give us $1,000. This is going to be what our journal entry would be for, would be the $1,000. Now, realize that if it is a quarterly amount, we are going to be looking at 3 months. If it was for a semi-annual amount, that is going to be 6 months. So you just have to look at what it's asking you and decipher that as far as the problem goes. So what we would have for this particular journal entry is we would have an insurance expense, and then you would have your prepaid insurance for the $1,000. The thing to remember here is that when you see the word expired, that means that that is what we've used. This will be the journal entry. So if you ever see expired, no, that's what you're finding is that journal entry amount. The other thing it could tell you is that $2,000 is unexpired. Now, what does unexpired mean? Unexpired means not used. In other words, this should be the balance in the account. So what I'm looking at here is if I was looking at the prepaid insurance account and it had $6,000 in it currently, according to the trial balance, I need that account to be $2,000. Now, how do I get to there? Well, I need an amount on this credit side. And what I need here to make this balance out, I would need $4,000. So that $4,000 is going to be the journal entry amount. And what I would have is I would have insurance expense for that $4,000. And the other side is going to be that prepaid insurance for $4,000. So again, there's two different ways that I could look at that particular entry. The last prepaid expense that we're going to look at is depreciation. Now, the definition for depreciation is the process of allocating the cost of an asset to expense over its useful life. So what we're doing is we're just allocating this expense. So if we have something like a computer and we think the computer is going to last for 3 years, then what we would do is we would allocate that cost over a 3-year period. Now remember, this is an allocation. It's not a valuation, okay? So we're not trying to value the property. We're just trying to allocate that expense over the useful life. It does not attempt to report the actual change in value. So we will use accumulated depreciation as the account that we're going to use for this. Now, accumulated depreciation is what we call a contra asset account. Contra assets have the opposite normal balance from a regular asset. So a contra asset would have a normal balance that is against or contra to an asset account. So it would be a credit balance. It would be its normal balance. The other thing we have to look at is it will offset the asset account, and it will give us what we call a book value. Now with book value is the difference between what it cost us and any depreciation that has been taken on it. So if we take and we purchase the equipment for $10,000, we have $1,000 worth of depreciation. We have equipment of $10,000 less accumulated depreciation of $1,000. That is going to give us net equipment of about $9,000. So this net equipment value here of this $9,000 is actually what we would call the book value for this piece of equipment. This is what your balance sheet should look like. All right, so we have added something in. It's a contra account, so it will be subtracted out. Now, you will see contra accounts again. So this is the first contra account that we see, but we will see more. So we would be subtracting that out. So if I told you that we had $1,000 in a depreciation expense, the journal entry that we would actually be looking at here, you would have the depreciation expense account for $1,000 as a debit, and then you would have the accumulated depreciation is going to be your credit for $1,000. For depreciation, it will always look like this, okay? Always look like this. So everybody should be able to realize that this is what the journal entry should look like. You will take depreciation expense and have a debit. Accumulated depreciation is a credit. Remember, we have an expense account as our debit, and we have in this case, a contra asset account for our credit. The other type of prepaid items that we have, so the second type of prepaid item is going to be this unearned revenue account. With unearned revenue, this is where we receive the cash before we perform the service. An example of this, if you think about it, when you go in to see a lawyer, before that lawyer will start doing work for you, he's going to take a sum of money up front, which is called a retainer. Now that retainer, he has not earned that money yet. As he earns that money, it has to be moved to revenue. But until he earns that money, he owes it back to you. So if he does not use all of what you have paid him for that retainer, he has to give you that money back. So that is a liability to him until he actually performs that service. All right. Now, some other examples that we have are airline tickets. They're not revenue to the airline until you've used it. Magazine subscriptions. It's not revenue until they send you your magazine. The other one that we use today is gift cards. If you go in and purchase a gift card, that is not revenue until you redeem that gift card or until that gift card expires and it becomes revenue. So those are other examples that we will see. Now, when somebody prepays for a service, we go in and the entry that we would make would be for cash, and let's just say it's $2,500, unearned revenue $2,500. So this is during the month somebody's prepaid for it. What we have to do is as we earn it, we will move it over into revenue. We normally look at it at the end of the month or the end of the period to see how much of it we have earned. Now there's two ways that this could be stated. The first way is the balance in the unearned revenue account is $1,000. So the first thing you have to do is find the amount in the trial balance. And in this case, we look at the adjusted trial balance. We find that the balance is a credit for $2,500. We need the balance to be $1,000. So that's going to be the balance. So we need to figure out what our journal entry is going to be. And in this particular case, the difference is going to be a debit of $1,500. So that unearned account needs to be credited for $1,500. So our journal entry here is going to be unearned revenue, and the other side of it's going to be the service revenue for $1,500. Now what you see here is we do have a balance sheet account and we have an income statement account. When we look at unearned revenue, you are going to decrease, all right, a liability. When we decrease a liability, we decrease a liability on the debit side. We're going to be increasing a revenue account. And that is going to happen on the credit side. And that is what we do for all of our unearned revenues. You would decrease a liability on the debit side, increase a revenue on the credit side. So the other way that it could be stated is it could be stated that $1,500 of the unearned revenue has been earned. Whenever you see has been earned, know that this is the journal entry amount. You don't have to figure anything out. That is the amount. So you would just do the entry and it would be unearned revenue for the $1,500, and you would have service revenue as your credit for $1,500. Now, realizing that service revenue can be called lots of things because it is a revenue account. So it could have been called income from services. It could be just fees earned. It could be fees. I mean, there's several things that your revenue account could actually be called, and all of those would be acceptable in that particular case. So that really does pretty much wrap it up as far as the deferrals are concerned. for adjusting entries. So now you should be able to go in and look over some of those entries that require you to look at it. Just remember that you always should go to that trial balance, adjusted trial balance first, and pick up that balance and see, is there something that you have to look at as far as that balance is concerned. The next part we are going to look at in the next video will be the adjusting entries for accruals.